In the early 2000s, America was booming. Houses were selling fast, and banks were handing out mortgages to anyone who asked. It didn't matter if someone had bad credit or no income at all. If you wanted a loan, you got one. Banks weren't doing this out of kindness. Every time they issued a mortgage, they made money. Because instead of holding the loan and waiting 30 years for someone to repay it, they sold the loans to Wall Street as quickly as possible. The more mortgages they created, the more money they made. So they stopped checking if people could actually pay them back. Wall Street bundled thousands of these mortgages together and sold them to investors around the world. As long as housing prices kept rising, nobody questioned anything. Regular Americans felt confident too. People bought second homes, invested in rentals, or pulled cash out of their houses. It felt safe because everyone believed home prices would never fall. Then, the first cracks appeared. Homeowners with the riskiest loans started missing payments. At first, it looked like a small problem, but the truth was simple. Once a few people stopped paying, the whole system began to unravel. Those mortgage bundles that Wall Street sold as safe suddenly weren't safe at all. Their value dropped fast, and investors panicked. Banks panicked too. They stopped trusting each other, and once that happened, lending across the entire economy slowed down. And in a modern economy, when banks don't lend, everything slows down. Businesses can't borrow to operate. Companies can't pay workers. People lose jobs. In September 2008, the situation exploded when the giant investment bank Lehman Brothers collapsed. The bank had loaded itself with enormous amounts of risky mortgage investments. When those investments lost value, investors refused to lend it money, buyers backed out. With no funding left, the bank failed, and that failure showed the world the problem was much bigger than anyone had admitted. Markets crashed, companies failed, millions of Americans lost homes and jobs. The government stepped in because the financial system was close to freezing completely. The Federal Reserve injected billions into the economy, supported major banks, and tried to stabilize everything. Without that intervention, the collapse could have been even worse. Looking back, the crisis didn't start with one mistake. It was a long chain of them. Banks ignored risk because they wanted profit. Wall Street built massive structures on top of weak loans. Rating agencies didn't warn anyone, and millions of people were encouraged to borrow money they couldn't realistically handle. Could something like this happen again? Not the same way. The rules changed. Banks are watched more closely. Mortgages are harder to get. The system learned from 2008, but financial crises don't repeat. They evolve. The next one, whenever it comes, will start from a different part of the economy.